Hey guys, it's Sasha. The stock market is taking a big beating this morning. The S&P 500 is down 0.8% in pre-market trading and is now 3.4% down just so far this week. After a bumper rally in August, the stock market is now down 22% so far this year, firmly back in bear market territory again. Many growth stocks are 2% down this morning, continuing the massive sell-off after Jerome Powell announced the 0.75% interest rate hike just 2 days ago. US inflation has so far refused to budge, sitting at 8.3% and increasing 0.1% month-on-month in August. Food prices and rent prices are increasing at around 13 to 15% a year, far above inflation, causing an unprecedented squeeze on living standards. Treasuries in the US have smashed through the 2018 highs, with 2-year notes yielding 4.2% and 10-year treasuries hitting levels we haven't seen since the financial crash in 2008. Russia has just called up 300,000 new recruits into their army, applying the age-old strategy of throwing more bodies at a problem when you're incapable of figuring out how else to solve it. Putin is waving the nuclear weapon flag in desperation and saying he isn't bluffing. The Russians are also busy annexing 4 new Ukrainian regions by holding sham referendums this week, and the gas tap to Europe has now been shut off for 3 weeks. So you might not be too surprised that the stock market is having a bad week. Some of the most popular stocks have seen their share price absolutely destroyed. Google has dropped below $100 and is now trading at prices lower than back in January 2021, almost 2 years ago. AMD, the computer chip maker that has seen performance explode in the last 2 years, is trading at below $70, the lowest price in over 2 years. And if you're invested in any early stage companies like me, you'll be feeling some serious pain in the market, regardless of which company it is that you're invested in or what their fundamentals look like. Welcome to the 2022 stock market crash. The great COVID crash, maybe the Russian crash, name TBC. So you are sitting there, it's getting darker that little bit earlier every day, the weather is getting dreary, and Christmas is still too far away. What exactly should you be doing about your stocks? Are we only halfway to the very bottom because the boy who cried wolf for a decade was finally right like a broken clock twice a day? Should you listen to YouTube that tells you that you need to sell everything because the market is down, investing is for losers, you need to sit on cash? It seems that everybody is running around waving their hands in the air and panicking. You turn on CNBC for a few minutes and the doom and gloom explodes out of the TV screen. It's unreal. Are we about to enter a huge recession? Is a depression on the way, and are we all about to lose our jobs? Do you need to buy a wheelbarrow to cart around your money because of hyperinflation? Is it time to actually panic? Well, here is the actual data, and you might be very surprised by what the data is showing. First, the energy sector has thrown a few interesting curveballs. Global gas prices are on the decline, dropping 23% in the last 3 weeks, and the price on European markets for gas are following the same trend. The United States has been sending record levels of liquefied natural gas to Europe, sending 15 ships to France, 10 to Spain, 8 to the Netherlands, and a grand total of 48 out of the 84 total ships from the US carrying liquefied natural gas turning up in Europe in August. The United States has formed a dedicated task force to rapidly increase their LNG exports, spending $300 billion on new infrastructure, and it is beginning to show already. Exports this year are up 20% on last year, with 2 new export hubs set up in Louisiana and Corpus Christi in Texas, and a big increase in exports expected over the next 4 years as a result. In July, the EU signed a deal with Azerbaijan to supply 20 billion cubic meters of natural gas along existing pipelines, and that is a pretty significant amount. That's about 40% of the amount that used to flow along Nord Stream 1 before it was shut in August. And that is already happening today. And Azerbaijan has been busy increasing their production by 10% so far this year, hitting 30.6 billion cubic meters from January to August, suggesting that their supplies to Europe could increase even further. Norway is increasing their production by 8% this year and expecting a new record of 122 billion cubic meters this year. And Norway has committed to keep their gas production at the current level or higher through to 2030. 2 weeks ago, the Netherlands opened a brand new terminal for receiving natural gas shipments, with the first delivery coming in from the US. These new terminals are based on huge ships instead of on land, and 18 more are in progress as the EU is spending 9.5 billion euros on the project. These floating terminals are apparently a lot faster and cheaper to build than land-based infrastructure, hence why they are being done this year. So in just the last few weeks, we have seen a monumental effort by Europe to to circumnavigate their dependence on Russian gas, and it appears to be working. The EU is also fast-tracking the introduction of price caps on Russian oil this week. At the same time, Joe Biden continues releasing strategic reserves of oil week after week over in the US to push down the price of oil and gas at the pumps, and that also seems to be working. Crude oil is down to $80 after a sharp fall in September and is now 31% down from the peak in June. Yesterday, Putin spoke to the Crown Prince of Saudi Arabia as the Saudis acted as intermediaries in a small prisoner swap between Russia and Ukraine. Now, relations between Saudi Arabia and the West have cooled down considerably recently. The Crown Prince had to cancel his trip to London for the Queen's funeral at the last minute because there was a bit of a hoo-ha about him coming, so Saudi Arabia is making new friends and turning to Russia instead. And completely coincidentally, at exactly the same time, through no collusion whatsoever, OPEC has decided to reduce their oil production by 10% starting from October in an attempt to keep the prices high. But the oil price just keeps on dropping, and we are seeing a global push towards replacing oil with renewable energy at an ever-increasing pace. The Inflation Reduction Act that just passed in the US provides heavy stimulus for transition to green energy, and there are massive efforts in Europe and other countries around the world. It looks like the day of OPEC and Russia collecting free money from the rest of the world for pumping black stuff out of the ground may now be somewhat numbered. The good news is that the situation with global energy is in a much better shape at the moment based on what we're seeing than it was early in the summer. And we're also seeing a drop in global commodity prices overall. Lumber price exploded earlier this year but has now dropped 70% since the peak in March. I know, I was buying a whole load of timber for some construction work earlier this year. It was painful. Same story with aluminium, iron, and even wheat prices have dropped 30% since Ukraine restarted exports, although the referendums on the 4 Ukrainian regions joining Russia this week are causing some turbulence. China has looked, it seems, at Russia's dismal efforts in Ukraine, and the situation around Taiwan has now calmed down significantly since Nancy Pelosi tried her best to blow the situation up for no reason whatsoever by visiting the island. And this is good for global business. Taiwan is a hotbed of global tech manufacturing, and so is China. And if China looks at Russia and decides that perhaps a military conflict with Taiwan is not the best course of action, that is going to be a boost for the security of the global economy in the years to come. And it's really interesting how Wall Street analysts react to rate increases. The 0.75% increase that happened this week was an almost dead cert. It was pretty much a done deal. Everyone knew it was coming. It was as good as announced in advance by the committee members. And yet, the market seems to have been surprised by it happening and threw their toys out of the pram immediately. I seem to be at odds with most in thinking that these increases are actually a good thing. Finally, the gap between rates and inflation is narrowing. The real interest rate is finally increasing after 15 years of being kept artificially negative and dropping sharply in recent months. You can see that as the inflation, the red line, was going up last year, the real interest rate dipped as the Fed sat around sucking their thumbs and talking about inflation being transitory. Now that they have finally woken up and are, doing their job, we're finally seeing the rates go up. And the gap between inflation and the rates is now narrowing. That is a good thing. And the sooner the real rate pushes towards the 0% mark, the sooner inflation is likely to get under some kind of control. The fundamental reason central banks increase rates is to make borrowing money more expensive and to encourage holding on to money. Less borrowing means people have less money to spend because they can't go and borrow money for cheap. And holding on to money also means people are spending less money through, holding on to it instead. And when people spend less money, demand drops and so does inflation. The overwhelming narrative from commentators seems to be that economic output is far more important than inflation. It measures everything. And I think this may be a common error from people who have never seen the impacts of hyperinflation or even just very high sustained inflation in their lifetimes. Maybe my personal view is warped as well based on when I was growing up, but I can tell you that the threat of runaway inflation and the impact on people's lives and the economy and basic ability of a country to function are far worse than a few quarters of negative GDP growth. The million-dollar question is, When will inflation start coming down, and when is the right time to stop tightening? The UK has decided to split their fiscal and monetary policy. Yesterday, the Bank of England increased interest rates by 0.5%, but today, the new UK Chancellor Kwasi Kwarteng has slashed taxes, income taxes are going down, corporation tax is going down, the highest tax bracket of 45% is being removed, national insurance increase is being cancelled, and at first this seems odd. Yesterday you were trying to tighten the economy, and today you are stimulating the same economy, but then there may be a method to the madness, because there isn't a necessary absolute reason why you can't do both, even if we haven't seen it done before. You could increase rates to discourage borrowing, reduce demand, try to curtail the level of spending, but at the same time be encouraging the growth in economic output of tomorrow by stimulating businesses. Now, it could go horribly wrong if demand drops off sharply enough that the businesses you are stimulating get crushed in the process at the same time. But if you time it right and the economic recovery that you are promoting coincides with the period where inflation starts dropping and demand is increasing again, it could be a massive springboard for a big economic leap. In the UK, the sharp change in policy came about because we have a new Prime Minister in Liz Truss and a new government. But it will be interesting to see if other countries decide to follow suit with this somewhat unorthodox strategy in the coming months. I am guessing the midterm election results in the US may have some impact. The numbers are indicating that we may well be at a turning point, but it is possible that the inflation wage spiral has been let to run for far too long, and if that is the case, we will be seeing a lot more pain and more drastic rate increases coming sooner rather than later. But if global prices start receding as the energy crisis is solved, commodity prices drop, supply chains improve, there is every chance that we see a big recovery instead of the market dropping another 20%. The fact remains that I do not know, and neither does anybody else. There will be many people out there who will take a gamble and proudly announce that they are the messiah, they have the magic ball that tells them what's going to happen, and if they call heads and it ends up landing heads, there will be a lot of bravado saying they knew all along and they were right. But in the long term, trying to gamble, trying to guess which way the market will move is futile, unfortunately. And all I am seeing is the entire supermarket full of my favorite stocks is having massive bright yellow discount stickers, and while everybody else is panicking and busy selling out into cash or whatever other nonsense, I am very excited to go and do some shopping over the next quarter. If you found this video useful, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching, I really appreciate it, and as always, I'll see you guys later.